Welcome to Top M&A Entrepreneurs Podcast. I have my guest, my bestie, CFO strategist, Holli Moeini, back to talk about some SDE, net profit, EBITDA, and cash flow, because there's a lot of misinformation out there.
Yes. Thank you for having me on Top M&A Podcast. And I love being here with you. I love how you think, and it's going to be exciting today. So in the world of business deals, if you're using the wrong metric, it could cost you thousands, maybe even millions of dollars. So you want to get your metric right.
Yeah. All right. So
one
you
more
want to go into this? Yeah, go on.
One more thing, more thing, Jon. Just belabor me one more point, so nobody will turn the show off and they'll go the full route. Okay, so here's what I'm going to say. It's like SDE, EBITDA, net profit. If you're using that in place of cash flow, it's like taking a screwdriver and trying to hammer in a nail. While the screwdriver is a useful tool, it's not the right tool for the problem. So I think, Jon, as we go through this, if we think about what is the business problem we're trying to solve, what is the right metric to use?
Great. I've got a little presentation because I came across some SIMs that to me were SDE outrageous. All right, let me share my screen.
When do you want me to tell you how I feel about SDE?
Okay, can you see any of this?
I mean, I can barely see it. I can speak to it, though.
All right, so these were, I'm going to make it a little bit bigger here. You got add backs and adjustments. Purchases, I don't know what that was, but, we can look into that bigger. But materials and supplies, kind of curious how that's an add back, if that's part of a legitimate expense of the business. One owner's salary. Now, this could be legitimate if there's one owner that's not doing anything, is not going to be around next year, didn't provide any benefit. You may be able to get a partial add back on that. We don't know.
Yeah, I mean, sellers, SDE, typically you do add back the owner's, salary, but
right. But if you're doing SDE and it's a nominal fee, so let's say $150,000, you're not going to go to an SBA lender and say, no, I'll just waive I'll take a less of a salary, let's say $50,000.
Yeah.
To make sure it covers the 2.0 or 1.5 debt service coverage ratio. They won't let you do that.
Yeah. Well, and what I say is SDE is useless to me. Excuse me, useless to me. It's like an Allen
Tell us how
wrench.
you really feel.
Yeah. It's an Allen wrench. What do you really use it for? And so you're actually showcasing that here with your example, because there's only one business problem this should be used for. And unfortunately, they just did it wrong. So they calculated it wrong. But the one business problem is if you're a small business, sometimes they value you at SDE. So probably the valuation experts are going to hate me for saying this. It's an Allen wrench. It's just not useful. And that with which you are showing is not useful either, because those add backs are really not appropriate. I can't imagine.
So here's the net income before taxes, $162,000. Here's the add backs, $642,000.
Yeah, no, I mean, that's an indicator you got a problem.
And they valued the business based upon this basic SDE.
Now I might go for that if the person that was the owner was paying themselves $500 of that $600,000. I mean, like if they were paying themselves a big amount and just taking a bunch of money out, that makes sense to me. Now, because when SDE should only be looked at from a buyer's perspective, if you're going to go in and run the business, and then you can look at, okay, what does it look like without any salary? How much am I going to pay for myself? How much am I going to have to service the debt? Right? Okay, that's the only reason it should ever be used. It's useless to me. In fact, I've bought many businesses, and even small businesses, I use the EBITDA, multiple of EBITDA, not SDE.
Yeah. This is the most outrageous one I've seen. I mean, it goes from $162,000 to $800,000.
Yeah, and the categories don't make sense.
Yeah, the like telephone. Well, I'm pretty sure the telephone's going to be there next year. So if the expense is going to be there next year, it's not an add back.
Right.
I mean, there may be some situations where, he gave telephones to a whole bunch of family members and none of them are no-shows, or let's say half of them are no-shows. That's okay, right?
Yeah.
I get that.
100%.
But internet, that's not an add back. You're going to have to use that. Utilities, that's not an add back. Do you think you'll have legal and accounting fees next year?
I think so.
Computer equipment. Do you think you'll be using computer equipment next year? Yeah, I think so. Do you think your janitorial cleaning, 1,500? Do you think you'll be doing janitorial cleaning at the office? I think so. Now, travel, that is arguable, right? We got to see what the travel is. If they if they went to a trade show based upon to help their business, and the the travel coincided with it, they could take some add backs on that.
Yeah, I think so too.
Entertainment, $2,900. Here's a vehicle and gas. Now, this is a company that drives around. They have trucks.
Yeah.
So is that expense going to be there next year? Yes.
Yes.
Repairs, insurance, all of that stuff. That is $60,000 right there.
Yeah, what I've seen in a lot of them that they try to add back is like the owner buys food every day for himself or herself, and they try to add that back. And, like if it's a culture and you're paying the employees and with food, it stays in the business.
Yeah. Well, think of Google, man. They have breakfast, lunch, and dinner, right?
That's right.
For all their employees. You can do that. Yeah. So I just wanted to show you this real. This is the most outrageous SDE add back I've ever seen.
Yes. Yes. And I think it's wrong. And again, I think SDE is limited in its usefulness, like an Allen wrench, and, should only be used in special occasions. So I love your definition. I'm going to make it even easier. Well, how do you want to approach this?
Yeah, go ahead. I mean, SDE is not cash flow. It's not cash flow.
No, it's not. And so this is how I think of it, because nobody remembers a formula, but they can remember that we think I think it's useless. However, the calculation is EBITDA plus owner's salary. That's SDE.
Okay. Yeah.
So you got to get to an EBITDA. Well, we'll get to there, but that's what it is. So it's just that. It's EBITDA plus the owner's salary. So if I'm a small business owner and I'm trying to sell and drive up my SDE, definitely I want to work on my EBITDA, increase the business, increase the profitability. And then if I'm trying to do tax strategies, let's say, and I want to bonus myself, I don't want to take expenses against the business, but I want to reduce my tax. Maybe I bonus myself because that gets to be added back. So there are strategies around SDE that are useful if you're trying to sell a business.
Yeah. And I'm not saying attaching nefarious means, unethical means to a broker, but if I add a ton of this stuff back and I say, well, look at that, your EBITDA or SDE is $800,000, and in this type of business you're going to get a 3.5. Well, that's a higher number. 800,000 times 3.5 is a different number than 162,000 times 3.5.
Yeah. Well, and when I'm on the buying side or on the selling side, I might push the envelope a little bit. I might put a few add backs that maybe you could question, because you might get away with it.
You may. Depends on who's buying it, right? If they really wanted it, that's like. Now,
that's right.
However, there's one underlying government type of underwriter that's not going to do most of that at the time.
Right. Yeah. You're right about that.
So let's talk about net profit. What's the difference between, now we got SDE, that's like discretionary add backs. What's this net profit?
Well, I mean, it's really only used for one business purpose. Again, what's the problem we're trying to solve? What we're trying to solve with net profit is it's your bottom line after you pay for everything. And it's your bottom line, and it's really saying whether your business model works. Are you profitable running your business as you're running it, with the interest payments, with the all the things, depreciation, you're buying equipment, on putting it on the balance sheet, and you're depreciating it. So does your business model work? You need to look at net profit for that.
Yeah, now that's with accrual accounting. You can't always tell a business how a business is doing with cash accounting, because you're going to see some months look pretty ugly compared to other months.
Well, and you got to do a heck of a lot of averaging. That's what I say. With the cash business, you got to go, I like to go back farther. I like to do a lot of averaging, looking at trend lines so you can see anomalies versus just, the normal fluctuations. We pay commissions quarterly. So we have really nothing going on. And then we have this big expense, like those things you can see, they're visible. Like the financial statements tell a story, Jon. And, the more you can get, the bigger, like we want lots of chapters so that we can read the story. And so you can see that kind of thing, and you can expect it. And when you don't see things you expect, then you have questions.
You need context. You definitely need
100%.
Compare year to next. Great. Yep. Net profit. Let's go over to EBITDA now. This is the number that our mutual buddy, Adam Coffey, says that all mid-market businesses go by, EBITDA.
Yeah, EBITDA. And so the thing that I like about EBITDA, and the thing that when I bought companies, I use EBITDA, even for small businesses and medium sized, is that it kind of normalizes the playing field. When you take out non-cash expenses like amortization, depreciation, interest, you take out all these things because you can normalize across the industry and compare company to company and really get a good flavor for what is that profitability, not looking at, how much debt they have and having interest in there, or how much depreciation. It really is a normalizer. And so I like to look at it when I'm looking across all, and across companies for comparisons. Now, for my companies that I'm actually working at helping them sell, is we have a line item on the P&L for EBITDA. And what I would say is, this definition we have here on the screen is the definition. But then if you're going to sell, there's the adjusted EBITDA, which means you take out those personal expenses, just like you did on the SDE. So you'd take out all those personal expenses, you'd take out all the, the hocus pocus personal stuff that you have, the family members who have certain things, and you normalize it. So I like an adjusted EBITDA, but like, in your books, if you're trying to sell, you watch that EBITDA line. You can watch the net profit line, but that's the business problem you're looking at solving. Is really you're looking at your EBITDA, trying to provide more value so you can sell at a higher multiple.
So let me ask you, depreciation and amortization. Now that's a legitimate add back, but it's a non-cash event.
Yeah.
So that doesn't really add to cash flow how I can determine debt service coverage ratio, right?
No. And so, no. And so, I mean, that's when like we're inching towards cash flow, right? Because, when you look at EBITDA is not deducting out, like for example, if you're looking at buying a company that has an EBITDA, but they haven't invested in their fleet of equipment or whatever, fleet of vehicles or equipment for a long time, and you're analyzing that saying, oh my gosh, I'm going to have significant capital expenditures. So if you're trying to look and gauge your cash flow to know whether does this company make enough money to actually run post acquisition, be able to buy the equipment and be able to wait for people to pay me, which is called working capital, right? That's when we're getting into cash flow. That's why none of these things we just talked about equal cash flow at all. It is the wrong metric, the wrong tool for solving the problem of cash flow, if that's what we're looking at.
All right, let's go on to cash flow.
Let's do it.
Cash flow gives a clearer picture of the cash available for operation, investments, and debt repayment. Just exactly as you talked to when you're going to buy a company and you see they haven't upgraded their trucks in 5 years, there's going to be a big cash outlay going to that.
Yeah, 100%. And like, I want to say, bring back the statement of cash flow for the small business. And maybe it's not a bring back, maybe it's a introduce it to, because your statement of cash flow, it's in QuickBooks and you can get it where it shows. I mean, the beautiful thing about cash flow statement is it tells you, it has three buckets, Jon. One bucket is it tells you your operations. Well, what cash came from operations? Then it's separated, like how much did I have to pay for that equipment, Jon? And then the next separation is how much did I have to use to service my debt or take out distributions for the owners, right? Like it separates everything for you. And like, again, it's a story. So the cash flow statement just follows around the balance sheet and the income statement and reports on it in these categories, right? And so if you look over a period of time, what's beautiful is you can also see the story of cash. Like, what does it look like? Is it seasonal? What and you know, it's automated in QuickBooks. I'm sure if people aren't looking at their balance sheet, they are not looking at their cash flow statement. But this is an important one, and I think that you know none of the metrics that we talked before really hit that mark. And there's another term that's out there in our M&A world, in your space, Jon, is free cash flow. And free cash flow just takes it takes everything but your debt payment. Because what it's trying to tell you, the problem it's trying to solve is like, I'm buying the company and I want to know, after investing in that equipment that's old, right? And working capital, which means like, how long is it going to take me to get my receivables? And, you know, it looks at that whole entire equation and gives you a number to say, okay, is that enough to get my loan, or am I paying too much? This will tell you if you're paying too much. And then your debt service coverage ratio, I don't know if we're going to get into that, but like that's where you would be able to see, you know, you take your operating cash flow over your total debt service, you know, and that will tell you whether you're too highly leveraged.
Yeah. And SBA lenders are going to do that. And that's why I wanted to go to the next screen. Because once you take this deal over to an SBA lender, they're going to primarily they're going to make their underwriting decisions not on cash flow, not solely on SDE, net profit, or EBITDA, but on cash flow. That's what you're talking about.
Exactly.
Yeah.
Yes. And so you don't want to confuse that metric, right?
And so if that cash flow has a debt service coverage ratio for whatever that lending institution's offering, I mean, I heard something the other day of 1.25, 1.5. I prefer a 2.0 because you're going to probably make mistakes and you need a little cushion in there.
Well, let's talk about what that means. Okay. Yeah. I love numbers, but like, let's talk about what that means. So 1.25, yes. I mean, that's probably the floor. Okay. But what that means is you only have 25% of fudge room if something goes haywire. That's not a big cushion. That's your cushion. So everything over a 1 is your cushion, right? So you say, I want another, 100%, as a cushion. And honestly, I mean, we've talked about Adam Covey before, but I believe he says, no, you want 1.25 is not enough. You want to be above 2.
You want 100% cushion. Yeah. You want to be at 2.0.
You want to be 1.8 and above. You want to be in excellent. But the SBA will still give you the loan. You just don't have, to your point, and you said this, the margin of error.
Yeah. That's just uncomfortable. I'm a Dave Ramsey kind of deal there. I just scared of 10 years of debt at 1.5. Wow.
Yeah, I think people, like, when you fall in love and you really want a company, you tend to, it's possible that you pay a premium, and this will bring you right back down to reality if you're paying a premium. It'll you'll see it here.
So last thing they look for is historical cash flow. You talked about that. That's context, meaning I need to see what they've done over 3 years, because you're going to take on a 10-year loan. And you need to make sure that you can pay that debt back.
Yeah. Is it consistent? And, of all the deals I've ever looked at, including up to today, the ones I did personally, I don't know about you, Jon. I'd be interested to know, but I've never gotten a statement of cash flow. Never. In fact, I've had to create it. And most people can't create it, right? So It's like, what do you do? I mean, have you gotten a statement of cash? Nobody's doing them.
Nobody does that. Nobody asks for a statement cash flow.
Right.
So I used to work for an Intuit, and it's as easy as creating a balance sheet. It's right there. It's a button.
right there.
You can send that too, but nobody does it. Yeah.
Like I did a seminar where I said I can make you a master's in cash flow in like less than 5 minutes because it's literally there and it tells you so much.
Yeah. Well, folks, that's the difference between SDE, net profit, EBITDA, and cash flow. And I want to thank my guest, Holli Moeini, CFO strategist.
Thank you so much for having me.